Welcome to the Luxury Channel. In this video, we'll be revealing common investing mistakes that the ultra-wealthy never make. From decision-making skills to risk assessment, we'll show you what sets successful investors apart and how you can adopt their winning strategies to improve your own investment decisions. So sit back, grab a pen and paper, and get ready to take your investing game to the next level. Number 1. Being over-invested. Investing can be a nerve-wracking experience, especially when the market is volatile. It's natural to want to keep tabs on your investments and ensure that your hard-earned money is working for you. However, constantly checking your portfolio can be counterproductive and lead to unnecessary stress and anxiety. It's important to strike a balance between keeping an eye on your investments and giving yourself a break. If you find yourself losing sleep over your investments, it could be a sign that you're overinvested. While it's important to diversify your portfolio and spread your investments across different asset classes, over-diversification can have its downsides. When you're invested in too many different securities, it can be challenging to keep track of everything and know when to make adjustments. Number 2. Not taking out profits. Another common strategy in investing is to take profits along the way. This means that when an investment has gone up in value, you sell a portion of it to secure some profits. This is similar to dollar cost averaging, where you invest a set of amount regularly regardless of the market conditions. By taking profits regularly, you ensure that you have some profits set aside, even if the market takes a downturn. This strategy was used by some early investors in cryptocurrency who made a lot of money when the price of their investment skyrocketed. They sold off some of their investment, taking out their initial investment and some solid profits, and left the rest untouched. This is known as a free roll and is a tactic used by wealthy investors. Once you've taken out your initial investment and some profits, you don't need to worry about what happens with the rest of your investment. It might continue to increase in value, and you can continue taking profits. Or it might decrease to zero, but you won't be affected because you've already cashed out. The reason some newbie investors don't use this strategy is because of greed. They want to make as much money as possible and think they can't do that by taking profits regularly. Others are just gamblers pretending to be investors who are willing to bet everything on one investment. The problem with this approach is that you have to be right 100% of the time to make a profit, and one unexpected event could cause you to lose everything. Number 3. Investing based on news, newsletters, or forums. When it comes to investing, people tend to rely on what they see or hear from the news, newsletters, or forums. Older individuals may tune in to financial shows like Kramer on CNBC or Fox News, while younger ones may follow Wall Street bets on Reddit or other meme stock channels. But relying on these platforms alone can be chaotic and unreliable. It's important to remember that nobody can make you rich, and that the key to success is being laser-focused on something you truly understand. Take the risk that you might be wrong. And if you are, then accept the reward or loss that comes with it. News, newsletters, and forums should be treated as entertainment, not as a primary source for investment decisions. By keeping this in mind and using these platforms wisely, you can avoid making hasty or uninformed decisions and potentially improve your financial success. Number 4. Panic selling. Panic selling is when people sell their investments during a market drop, thinking they can buy it back later at a cheaper price. However, this strategy rarely works. The media often portrays market drops as complete failure and causes uneducated investors to panic and sell their investments to minimize their losses. But the ultra-wealthy revisit the fundamental principles of investing and assess if anything has changed since their initial investment. They ask themselves if the promise of the investment is still the same, if the company is still around and profitable, if the fundamentals are good, and the long-term vision for the investment is still intact, then the ultra-wealthy see price drops as an opportunity to buy more. Here's a story about how Jeff Bezos, the founder of Amazon, is actually really smart when it comes to business. In the year 2000, the stock price of Amazon dropped by almost 90%, and the media was saying that the internet and tech industries were doomed to fail. But Jeff knew that Amazon was still doing really well, so he wrote a letter to the company's shareholders explaining how the company was actually doing better than the year before, despite the drop in stock price. Amazon also bought back some of its own shares at a big discount. Once people realized that their emotions were clouding their judgment, they saw that Amazon was still really valuable. Number 5. Rebalancing your portfolio. Many beginner investors make the mistake of setting up their portfolio and never looking at it again. However, this approach does not work. The frequency of rebalancing depends on your investment strategy, but the super wealthy tend to do it every couple of years or once a decade, assuming no significant financial events occur. Rebalancing means adjusting your portfolio to maintain the desired investment ratio. Rebalancing your portfolio regularly will keep your investment safe and growing over time, regardless of the market's ups and downs. Number 6. Investing in unfamiliar. The super rich prefer to follow the proven path. This path is reliable and can lead to success. However, other people may try to distract and mislead you with fancy and attractive things. It is not necessary to invest in exotic ventures such as emerald mines in Zambia or real estate in Dubai if you don't have a clear understanding of them. Be cautious about who you seek advice from and make sure you understand the basics. If you can't explain an investment idea clearly to someone else, you shouldn't invest in it. Following this simple rule can prevent you from getting into a lot of trouble. Number 7. Poor on cash. The way rich people view money is different from those who are still learning. Poor people buy assets with the hope of selling them later for a profit, while wealthy people buy assets with the intention of never selling them. This is the difference between making money and building wealth. Once you understand this concept, you will see investments differently. Wealthy people treat their investments as a personal piggy bank that grows over time. This approach allows them to look at the market differently, and if an investment's market price goes down, they see it as an opportunity to buy at a discount. That's why the ultra-wealthy always have cash on hand waiting to be deployed, and their investments are focused on generating income. Poor people make one bet and hope for the best, while the rich are in continuous accumulation mode. Number 8. Short-term bets and trades. The ultra-wealthy know that making quick investments is a risky move. Let me share a lesson taught by a business owner on the difference between the wealthy and everyone else. When wealthy people visit a casino, they do it for the entertainment, fully aware they will spend money and won't necessarily walk out with more than they came in with. On the other hand, poorer individuals visit casinos hoping to make money, doubling or tripling their earnings. However, the odds are never in their favor, and they are more likely to lose money. For the wealthy, it's about the experience and thrill. In investing, this difference is crucial because it differs significantly from gambling or speculation. The ultra-wealthy prefer investments that they can leave untouched for years. In contrast, inexperienced traders make many short-term trades, leading to frequent fees and taxes, which chip away at their profits over time. In conclusion, while investing can be a challenging and complex process, avoiding these common mistakes can significantly increase your chances of financial success. By learning from the experiences of the rich, we can all strive to become more knowledgeable and effective investors and work towards achieving our own financial goals. Remember, Investing is not only about avoiding mistakes, but also about making informed and strategic decisions that can ultimately lead to long-term prosperity. That's all for today. If you enjoyed this video, please like, subscribe, and hit the bell icon so that you never miss an upload. See you in our next video.